RSI is one indicator in this series of short videos that review tools used by chartists when trading in the stock market. Even if you've been trading for a while, these simple and short refreshers can really help. Relative strength has long been known as a valuable investment tool. Jesse Livermore in the 1923 classic Reminiscence of a Stock Operator noted that prices are never too high to begin buying or too low to begin selling. In other words, stocks showing higher relative strength are likely to continue increasing in price, and it is better from Livermore's perspective to buy those stocks than to buy stocks with falling prices. What is the Relative Strength Index, or RSI? The Relative Strength Index, or RSI, is one of the principal momentum indicators used when analyzing charts. RSI is a technical momentum indicator that compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an asset. It's calculated by using the following formula noted on your screen. Please note, where you see RS, that equals the average of X amount of days up closes divided by average of X amount of days to down closes. Down here you'll see this is my chart that I have set up and how my RSI looks. But on standard charts you'll see RSI may be looking like this. RSI ranges from 0 to 100. An asset is deemed to be overbought once RSI approaches the 70 level, which is notated here on my chart as the upper line. And that meaning that it may be getting undervalued and is a good candidate for, it may be getting overvalued and is probably a good candidate for a pullback. And likewise, if RSI approaches 30, notated here as the lower line, it's an indication that the asset may be getting oversold and therefore is likely to become undervalued. Two common settings for the upper and lower lines are standard of 70 and 30, as you see here, as well as 80 and 20, because these will clear out some of the false buy and sell signals that you'll see. Let's take a look at an example of RSI in action. If you look here on this chart of the S&P, you'll note that RSI gets oversold at the beginning around, at 0430 on February 26, 2016, and begins to trend down. When RSI is overbought, it kind of gives you an indication that maybe it's time to begin a short position at that point. You'll see that RSI is trending down and that it's creating lower highs and lower lows. And when you look up at the price action of the chart, you'll also notate that it's trending down with RSI. As we come down to the bottom, it never meets the lower line or becomes oversold, but you do see there's a couple of yellow arrows there that notate the lowest low followed by a higher low and another higher low and continuing. And this indicates the end of that trend, and that you can see here the RSI begins to turn upward and trend up. So does the price action. This is going to give you the idea and opportunity to sell your short position and begin a long position. You'll do the same thing as it trends up, finds a peak and starts beginning to create lower highs. You'll sell that long position and open a short. If you look here, you can see the same chart we were looking at with the same RSI and the same markings. You'll see on the 30-minute that we grasped looks like an entire day minus an hour, so 23 hours worth of trade on the 30-minute chart in the upper left-hand corner. We were short for 23 hours. You go over to the 60-minute, you can see that it matches up pretty nicely, but cuts out some of the jagged price action and noise clutter on the RSI. You look at the daily, we could have actually started that short another couple of days earlier based on RSI and followed it down. You can see that downtrend we caught the last half of. marked by those orange lines. And then on the weekly, you can see that on the weekly basis, this was actually a primary uptrend marked by the price action going up and as well the RSI moving up. But you'll notice on all of the smaller charts, we caught the downtrend. This works both ways for long and short positions. This should give you a basic understanding of the relative strength index and how it applies to the field of overbought and oversold positions. This is a very basic explanation, but this is also a very important indicator that gives professional traders signals for making the right decisions on both sides of the market. And simply put, the RSI, sooner than almost anything else, indicates an upcoming reversal of a trend, either up or down. If you enjoyed this video or would like to come trade and chat with other traders in a noise-free, friendly, and productive area, please come to greattradingschool.com and try a 5-day free trial and come learn with all of us. Thank you.